Feroze Azeez, the joint CEO of Anand Rathi Wealth, really joins in. Feroze, always a pleasure to chat with you. What do you make of the exuberance that the market is really showing? Of course, the crude oil prices are still elevated today, but there have been some good developments when it comes to Netanyahu reaching Washington. Also, the Middle Eastern countries really huddling together to find some resolution. So some of these are better cues, but there is nothing definitive positive for the market to really be in a good shape today.
Good afternoon, Nisha. I have been saying, and boringly so, that the market is going to be very buoyant. The news can get worse, but the market's reaction is not going to be as it used to be in the month of March, especially after the weekend war. So, would the markets fall again, 3, 4, 5%? That's always likely, and that's what the markets have shown for the last 26 years of this century, if you see. Markets average have fallen 15% every year. They find their own reasons. So what I'm trying to say is there's a lot of volume which has been traded at 24,000. Markets might be at the same level, but how much volume has traded on that? Everybody has got an opportunity to sell if they wanted to. They've got opportunity to buy if they wanted to. April, May, June, and almost July expiry, 4 consecutive expiries, we have seen 24,000 plus or minus 100 or 200 points on Nifty. Does this happen very often? The answer is no. Anytime market spends 4 expiries at the same level, it implies that if Feroze wants to sell, he had enough time to sell, right? Unlike in silver, right? If Feroze wanted to sell silver in January, did he get the peak price? No. If he woke up after 2 days, he would have got 10% lower than the peak price. So market solidity depends on how much time it spends on a specific place. So the buoyancy is coming out of the time spent, one. Second, what is going to happen is if you look at NSE 500's free float and mutual fund AUM, both active and passive, and see it as a percentage, you would be surprised that the percentage of mutual fund AUM as a percentage of the NSE 500's free float has gone up substantively over the last 3-4 years, which implies your dependency on FII has been high, but that will keep reducing as this ratio keeps going up. Nobody in the country tracks that ratio. I've seen this ratio, and you'll be surprised how the mutual fund AUM as a percentage of free float has gone up, and our reliance on the foreign money has been low. In spite of a 1.5 year selling, you still show no sharp drops from 26,000. That's the reason.
Feroze, in fact, that's the big takeaway coming in, that the self-reliance in the Indian market, where the domestic institutional investors and the retail participants are really ascribing the value which the FIIs really fail to, because we know the ground reality. So that's really coming out and decoupling from a day of elevated crude prices and Nifty 50 not going with the mood swings. Looking at this, one particular theme which really emerged in the market yesterday was the consumption stock, especially FMCG as well as retail, where 3 of the companies really showed poor either guidance or poor margins and volumes, and therefore the market really punished them in yesterday's trade. Looking at this scenario, and while the inflation concerns still continue because crude is above $85 per barrel, how do you look at the FMCG and consumption space from the sector perspective, demand perspective, and the stock perspective?
Nisha, I think I've expressed this. FMCG have been negative. The reason why to be negative is the rich valuation is not because of the expected growth. See, one is a PE ratio being high, but PEG being so high, growth is not there. Of course, I have interacted with some really large FMCG listed companies as their CXOs could be my clients. They themselves are not so bullish on the growth number. And for the last few years, do 60, 70, 55 Ps are justified? Maybe in an industry where there's growth of 30% expected, then PEG is just 2 on a 60 PE. But on a 60 PE with a 10% growth at best, you're still looking at a PEG of 6. No, that's ridiculously high valuations, both on the PE and the PEG basis. So if you see rich valuations, volume growth is still modest, margin expansion largely reflected in the price already, limited earning surprises. I think that's why you've seen some punishment. and I would be negative on FMCG. The reason why they're richly valued is because they have got some reasonably good passive ownership from indices, which is not free float. And that's why you see they keep going up. They've remained up in spite of growth not substantiating those valuations.
All right. So the long-term consumption's growth story of India is what is keeping this particular space elevated, but duly also punished on bad numbers or guidance. Feroze Azeez, always a pleasure to speak to you. Thank you so much for stopping by for NDTV Profit. Thank you.